Well, look, I think it's a good plan in the sense of we have had many years of sub 2% inflation. So the idea that the Fed will allow, when the economy starts to recover, we start hitting capacity utilization, we start to see a bit more inflation coming through, that allow the economy, as you say, to run hot for a bit longer. That's probably good news in terms of risk assets. I guess the question is, as we were just discussing, the question is, what's the credibility in them able to get the inflation up to 2.25%, 2.5%, as you were hearing then, because obviously we've been missing the 2% target. So I think overall it's welcome. It was quite well flagged. To be fair, this review's been going on for over a year. It's been flagged. So I'm not sure on the day it has a huge impact, but of course it's telling us really that interest rates are going to be very low for some time to come. And of course that's helping risk assets.
Nick, I would say there's a fair amount of uncertainty around banks at this stage, given non-performing loans, just what we're likely to see as some of those furlough schemes are rolled off. But curve steepening in the United States is a positive backdrop for many of those US banks. So what does that mean in comparison to European peers that may not necessarily benefit from that spread widening that we're seeing?
Yeah, it's a fair point. I mean, there's no direct benefit, as you say, in terms of if it's a US yield curve and Europe's relatively insulated, then there's no carry through. What we do look at, though, when we look at banks' performance in Europe, there's a very close correlation between the banks and inflation expectations. So if you look at the five-year inflation swaps, effectively what the market thinks inflation in Europe will be in 10 years' time, that's moved up from around about at the market low in March, around about 0.7, 0.8 to something like 1.25, 1.3. So still well below the 2% level, but nonetheless a little bit better. And normally that would mean banks would start to move up and start to outperform. But here in Europe, we really haven't seen significant outperformance by the banks, even since the market low. And I think, as you say, that's partly some of the uncertainty around how these NPLs will play out once we have a removal of some of these furlough schemes or Kurzarbeit we have in Germany, other temporary work we have across Europe. So for the time being, I think the market wants a little bit more clarity on NPLs, but certainly these types of moves and steepening yield curves, higher inflation expectations should start to help the banks, which are obviously very cheaply valued.